Today, Bitcoin dips below $30,000 to kick off the week. Backlash brews as the SEC moves toward DeFi oversight. And as the tax deadline approaches, Patrick White, the CEO of Bitwave, explains the need for businesses to account for crypto. Welcome to CNBC's Crypto World. I'm Pippa Stevens. Major cryptocurrencies starting off the week in the red as investors turn their attention back to the economy and bank earnings. As of noon Eastern, Bitcoin fell below $30,000 after it hit that key level last week for the first time since June. Meantime, Ether dropped, but still traded right around $2,000, the level it broke through last week following Ethereum's latest tech update. Polygon traded mostly flat. Okay, let's talk about the top stories. There is no doubt SEC Chair Gary Gensler is getting tough on crypto, and now he's making sure DeFi won't be left out. On Friday, the SEC clarified that the agency's existing rules on exchanges also apply to decentralized crypto platforms. The agency confirmed it's moving toward DeFi oversight when the regulator met on Friday. The SEC voted 3-2 to take more comments from the public after crypto firms criticized the plan for roping in DeFi platforms that would otherwise not be subject to the regulator's oversight. Now, the plan, which was first proposed in January 2022, would expand the definition of an exchange to include platforms that use communication protocols, such as requests for, quote, systems. SEC officials said that some DeFi platforms may fall under the proposed definition, but others may already be considered exchanges by the existing one. Now, without giving specifics, the officials estimated about a dozen crypto firms would fall under the expanded definition. Republican Commissioner Hester Peirce criticized the commission's plan, saying at the meeting that the reopening doubles down on an initial proposal that would force centralization and undercut new technologies. She argued during the meeting that the announcement sends a message that the SEC is not interested in facilitating innovation and competition in the financial markets. Decrypt reported that Peirce said the plan's ambiguity undermines fundamental First Amendment protections. Now, we reached out to Peirce but didn't hear back right away. Meanwhile, crypto-friendly Congressman Warren Davidson wants Gensler out of his role at the SEC. The lawmaker tweeted over the weekend that he is introducing legislation that would remove Gensler from his role as SEC chair due to crypto overreach. In the tweet responding to Paul Grewal, Coinbase's legal head, Davidson announced his intention to have Gensler removed to, quote, correct a long series of abuses. The tweet came one day after the SEC's announcement about revisiting the proposed definition of an exchange. We reached out to Gensler for comment, but didn't immediately hear back. Last, a new draft bill in the House wants to hit pause on stablecoins here in the U.S. The newly released draft, which was introduced by the House Financial Services Committee, would place a 2-year ban on endogenously backed stablecoins, meaning stablecoins that are backed by the issuer's own token. In other words, algorithmic stablecoins like Terra USD and the Luna token. As part of the ban, the bill would direct the U.S. Treasury, Federal Reserve, OCC, SEC, and FDIC to investigate these types of algorithmic stablecoins. At the same time, though, the bill lays out rules to let banks and other businesses issue stablecoins, although they would have to get approval from the OCC. All right, on to our main story. Last week was the NFT NYC conference, and Crypto World's Mackenzie Sigalos took the chance to speak to Patrick White, the CEO of Bitwave, which helps businesses with crypto custody and tax accounting. The pair spoke about tomorrow's tax deadline and what it means for businesses who hold crypto and NFTs.
Crypto, in a much more appreciable way than in past years, is now factoring into the equation when you put together those filings. Walk me through what people are dealing with this tax year.
Hi, Mac. Thanks for having me on. Well, what they're dealing with this year is it's not the first year of losses, but it's the first year of pretty across-the-board losses. So everybody who's in crypto probably had some sort of loss last year that they are handling. Crypto is like any other tax event. You can do tax loss harvesting. It can be a little bit dicey. Not everyone agrees that you should do it, but there are a lot of folks that went out there. They were sitting on Bitcoin. They bought it at 30K. Now, last year it was down at 15, so they sold it all and then rebought it to loss harvest. It's kind of questionable from the IRS perspective that that's okay, but you are seeing that across the board. This year, as like every year, talk to your tax professional. And if you're like most Americans, where you're about to sit down and do your taxes today, you might want to think about an extension because most tax people do need a little bit of time to handle the complexity of crypto.
Now, we've covered this idea of the tax loss harvesting in the past, and at one point there was chat about whether or not the IRS would be closing that loophole with respect to cryptocurrencies. Where is that right now?
Well, they haven't closed it per se. There's still, people who read the rules interpret the current rules for wash trading, which is where this really occurs, as not allowing wash trading in crypto. So be careful about that across the board. But then always be aware of the IRS. The IRS isn't like other agencies in the government. Most places a law gets passed, it's not retroactive. That's not the way the IRS works. Like if they decide next year that tax loss harvesting, that doing wash trading to wash out your losses is not okay, you have to go back and restate. So we generally recommend from Bitwave, we do tax and accounting software for businesses using crypto. We generally recommend that people do, in fact, take a more conservative approach. So with crypto, if you are looking at tax loss harvest, one of the things to do is instead of wash trading, which is to say selling your Bitcoin and then buying it immediately back, what you can do is sell your Bitcoin and move into wrapped Bitcoin or go from Bitcoin into some sort of liquidity pool where you get equal exposure to Bitcoin and USD. It's a way to keep your exposure to the asset, but demonstrably change it in terms of what the IRS is going to look for.
Now, as I mentioned a couple of years ago, there was no mention of crypto in any sort of IRS forms. Now it's right there on the front page, addressing any sort of holdings you might have. Do you anticipate, further regulations coming up, other tax obligations that might exist next year that don't for this past fiscal year? Something that people should look out for as they're building out their crypto portfolio.
Absolutely. Next year's gonna be the first year that 2024 will be the first year that you really start seeing crypto exchanges report to the IRS your trading activity. So up to this point, obviously no one should be lying on their taxes, no one should be evading it. But if you didn't have an exchange that was sending out 1099-Bs to the government, it's a little bit easier to get away with stuff. That's changing this year. So you want to be aware of it. It's a good excuse to kind of like scope down the number of exchanges you use. A lot of crypto folks tend to use a bunch of different exchanges, Binance and FTX. Well, not anymore, but all these different exchanges they would use. What's going to happen is that each of those guys next year are going to start sending 1099-Bs to the government with different cost bases. And it's going to make your taxes so much more complicated because you're going to have to track all these different inventories separately. And you might want to just think about narrowing down to using one exchange as a primary exchange. And not really futzing with a whole bunch of different ones.
Now, it's my understanding that you're in town for NFT NYC. And my question is, how do non-fungible tokens factor into the tax equation? Because typically we think about it in terms of Bitcoin that you have custodied with Coinbase, but are you also facing a tax obligation on those NFTs?
Yeah, absolutely. So NFTs, the way you want to treat them is they are a property asset. Now, in some certain circumstances, for art NFTs, they can be collectible. The reason that's important is that is actually a different tax treatment. So collectibles, if you are out there, you buy Ferraris for a living, buy and sell Ferraris, and that's your hobby, you still have to pay a gain loss on that. So just like buying stock, just like buying crypto, you have to actually pay gain loss. It gets taxed at 28% in the US as opposed to the gradiated 15%. For long-term cap gains. And so some NFTs actually fall under that. Now, one of the tricks of NFTs is they're a little bit more, they're harder to liquidate. And so if you are sitting on NFTs that essentially are worth nothing. So let's say you bought an NFT for $1,000 and today it's worth literally zero. It can be kind of hard to actually realize that loss. There are very specific rules for what you can do when an asset goes to zero. So there actually are a couple websites out there you can go to where you sign in, you connect your wallet, and they'll pay you, 1 penny for your NFT. And that way, that actually allows you to mark a price that you exited the NFT and pick up that loss from your original point. So it's a great thing to do if either this year or last year, if you could have already done it, to actually realize losses on NFTs that might not be worth anything.
Okay, that's all for Crypto World today, but we are back again tomorrow and we will see you then.